said a word. Thank you, dear. Thank you.
All right, folks, I'm going to go ahead and get started. If you do have any questions as I'm going through the information, feel free to stop me at any point. I'm more than happy to answer any questions that you do have. If you don't want to ask your question in front of everybody else, just jot it down, and I will stick around for a few minutes when I am done to answer any questions that you do have. First things first, this is us, Wisconsin Retirement Solutions Incorporated. We have an office over in Kimberly, Wisconsin. That is our only office. There are no other satellite offices or anything else like that. I mention that because that's the next new big industry thing now. These things will sweep through our industry for sales purposes. How do you make more money? Well, let's get you on the radio, or maybe get you a TV ad, or now the new thing is let's get you a satellite office. So you can put a satellite office in Green Bay, you can put one down in Oshkosh, you can have your main office in Appleton. What happens then? Clients get to see you a third of the time. I don't believe in that. My office is in Kimberly, it's going to be in Kimberly, and I'm going to service the surrounding areas. Now, if I have to drive to Green Bay to see a client, or down even Fond du Lac, I have clients, I will do that from time to time. But I will not be sharing time with Appleton or Kimberly in the surrounding areas. So I will stay here in Appleton. My name is James D. Van Bonderen, and you can call me Jim, most people do. I'm a member of the Better Business Bureau, member of the National Ethics Association, and a licensed independent insurance agent for the state of Wisconsin. Now, the information in the folders you can go through in more detail when you get home. I'm going to run through it very briefly. On the right-hand side, next to my business card, you'll see my profile. You will also notice that my business card doesn't have any other logo on it but my own. So when I tell you that I'm independent, exactly what I mean. I don't represent any insurance companies, brokerage firms, or any other entities other than my office. There are going to be some folks out there that are going to tell you that they are independent. They're going to hand you a business card that's going to have an insurance logo on it, or it's going to have, another brokerage company logo on it. Understand, they're not giving you independent advice. They might tell you that they're independent because they might have to pay half their monthly rent, or they may have to give up some commissions for certain things, but they're not truly independent if they have somebody else's business associated with them. Born and raised in Green Bay, graduated from the University of Wisconsin-Oshkosh, where I met my wife, Julie. Julie is the Vice President of Operations for Prospera Credit Union. Not that you have to do your banking there. That's just her job. My son, AJ, is 9 and now playing basketball. And my daughter, Ava, is going to be turning 5 in another 11 days. So, she doesn't play any sports because if it's not pink, she won't eat it, wear it, or play with it. So, she's all girl. We also live there in the Kimberly Darboy-ish area with our first baby, Samantha, or Sam, who is our now 12-year-old golden retriever. So, that's me in a nutshell. After that, you're going to see my membership to the Better Business Bureau. You're going to see my brochure for the National Ethics Association, and then my membership to the National Ethics Association. The National Ethics Association basically takes what the Better Business Bureau does a few steps further. The Better Business Bureau is going to do a background check, make sure that you're legit. There isn't a whole lot of follow-up after you pass that initial screening. You pay your membership fee every year, and you'll get to maintain your membership pretty much forever. They go back about 3 or 4 years. They'll do 1 or 2 background checks. The National Ethics Association does 16 background checks, and they go back 7 years, and they do that every year I reapply. So every year I'm doing a background check on myself for anybody interested in doing business with me, or any current clients that I'm currently doing business with that may have any concerns, especially with I shouldn't say recent developments, but the Bernie Madoff issues, Alan Stafford issues, those trust issues basically that have come up over the years. those don't apply to us, and these are the things I do to make sure that you understand. Last thing on that side is going to be a map to my office on the back, driving directions. On the left-hand side, you're going to see a brochure about investment scams, a Akron Badger schedule. Monday Night Football's on the back. Hopefully everybody's got one of these in there. Or are they way in the back? Way in the back. All right. The investment scams issue. It's kind of unfortunate that we even have to talk about this, but it was not too long ago, probably about 6 to 9 months ago, I had 2 clients. One who actually brought in a bank check, an actual bank check from a bank in North Dakota, and was told in this letter that they received that they could cash that check if they simply sent in $300 to process it. Now, anytime you got to pay to cash another check, some bells and whistles need to go off, but understand this was an actual bank check. It was stamped. So we called the bank. Yes, it was legit. It was a legitimate check that had been stolen 6 months earlier from one of their storage facilities along with their stamp. So somebody stole a box of actually legitimate checks and had now been stamping these things and sending them out. So they were actually real checks, they just weren't going to clear the bank. I had another client who was doing business with Chase. Now everybody's familiar with Chase credit card company. Unfortunately, this was Chase International and not a real company. And she invested 10 grand. She wanted some money back. So they said, in order to make your withdrawal, send us another 10, and then we'll send you the gains from your account, which would be 10%, which was 2 grand. So she had put the $10,000 in, another 10, which is $20,000 now. She asked for a $2,000 payment, which should have been her profits. Never received it. And unfortunately, as trusting as she is, she proceeded to send them another $30,000 over a 6-month period. So, anytime you have to send money to pay for something, or if you're a client of mine, bring it to my office. Just like the real bank check, we're going to call, we're going to find out, we're going to do some research. We're going to let you know, before you do anything unfortunate like that, what's going on. And that's why we put the brochure in there, just as a reminder that these things are still happening. One of my newsletters is in there. You'll see the solutions that we use to put your retirement plan together. This is how we build a profile of your situation, come up with our recommendations. There is a blank sheet in there. Once again, if you have questions you don't want to ask in front of everybody else, write them down so you don't forget them. Take notes on any information that you'd like to on that page. And then the last thing is just an example of my referral program, which is ongoing. Refer somebody to one of my seminars, $10 gas card like you did receive today. If they become a client, you'll receive a $100 gift card at any one of the businesses listed there. And those businesses are businesses that I frequent, that I spend my dollars with, and then I have clients that actually work there. So that's how we came up with that list. What do I do for a living? My job is to design a retirement plan for you that safely grows your money, provides you with a lifetime of income if you need it. All right? And we'll get into reasons why we want to talk about that, because a lot of people are buying these products that offer lifetime income, and they don't ever plan on taking income. So why pay for something you don't need? But if you need the lifetime income, we'll provide it, protect your assets from a nursing home if it becomes necessary. Transfer your assets to your heirs in the most tax-efficient manner possible at your death. All right? And we'll go through those legal issues and things like that in a little bit. But the big issue down here is understand what your choices are. That's the biggest thing that I want to emphasize. You have choices. Now, if you don't make any choices, understand that's a choice. You don't have a will and powers of attorney. You just chose to let the state of Wisconsin make your health care and financial decisions if you become incapacitated. And it doesn't matter if you're married. Okay, so we're going to go through those issues and concerns. Now, how do I do it? I take a look at the 4 aspects of your retirement: your estate and legal solutions, your tax solutions, your insurance solutions, and then your finance and income solutions. I do this with the use of a certified public accounting service, DVH & Associates. John Pendleton does a good majority of the tax returns for my clients. Not that you have to have your taxes done there. But he helps me with the mock tax returns that we'll run and any tax questions that I do have. Advisory services from Vision Advisors. I use them to research bonds, stocks, and mutual funds because I'm not Series 65 certified yet. So they do all my research because they are securities licensed. And then the elder law services of Clifton Crucier, Stiles and Crucier. He, his dad, and 2 other individuals have an office off the Ballard Road exit. He takes care of all my legal issues. Now, legal issues being wills and powers of attorney. Everybody in here should have one. If you have a trust, within your trust, there will be a will and powers of attorney. If you don't have a power of attorney, who's going to make your legal decisions if you become incapacitated? I mean, who's going to make your health care decisions? Who's going to transact for you at the bank or credit union? If you don't have that in place, even if you're married, okay, your spouse just can't naturally do that just because you're married. You'll have to go to court, and there will be a guardianship hearing, and then you'll be appointed guardian over your spouse, as ridiculous as that sounds. Understand, you're going to pay for all this. You're going to pay for the attorney to represent you in court. You're going to pay for the court costs to set you up as guardian. Hopefully your lawyer sets you up with the powers of attorney at that point in time. If they do not, and they only set you up as guardian over your spouse, every time you want to make a decision, whether it's a health care or financial one, you'll have to petition the court. You're going to have to ask them for permission. And understand that involves you involving an attorney. So it's important that you have your powers of attorney. Your will, that's a big misconception. A lot of times I'll sit down with people and say, you need a will and powers of attorney. I'm like, yeah, I need a will because this is what I want to do with this stuff, and this is what I want my personal representative to be. Understand, your will, in my opinion, is not very important, per se. It's a catch-all for anything that we miss. We're going to go through your financial situation and make sure you have all your beneficiary designations in place. If you have them in place and they are put in place appropriately, those assets will naturally bypass probate and will never end up in your will. The only thing that will end up in your will is anything that we miss. Okay? So even if your will says, I get everything when you're gone, if we listed on your IRA somebody has a beneficiary, POD your bank accounts, you have a beneficiary on your life insurance, all that stuff is gone when you're gone. So if your will says, I get everything, there won't be anything. Because nothing will end up in your will. Your will is what actually goes through probate. And we don't want to go through probate. So list your beneficiary designations appropriately, and you won't have that issue. A trust. A trust is a document that bypasses probate. And there are 2 forms. There's revocable, which you can change, and there's irrevocable, which you cannot. Now, a revocable trust is just a joint document. All right? Now, a lot of people come in and say, I think I need a trust. Or do I need a trust? My first question is, do you have $5 million or more? Because if you don't, there might be one reason why you don't need a trust. The other question I ask is, do you want to control all your money and assets when you're gone? Meaning you pass away and are gone, and now you want to dictate how much money this person gets and at what age. Or how much money they can take out to spend on these issues. If you want that control after you've passed away, then you might want a trust. Or if you have more than $5 million, you're probably going to need one. Unless you're okay with the state and federal government taking money from your beneficiaries after you're gone. Outside of that, normally what I do if somebody has one, I ask them what it owns. It's a legal document that bypasses probate. What does it own? Now understand, if you start with your assets, we're going to start with your qualified money. That's IRAs, 401ks, 403bs, Roth IRAs. Those are all individually owned contracts. They will never be jointly owned. Once again, a trust is a joint document. So a trust cannot own your IRA, your 401k, your 403b, your 457, your Roth. It can't own any of those accounts. Well, if it can't own those, what can it own? How about your bank or credit union accounts? Checking, savings, CDs, money markets? Sure. But understand, if you went to your credit union or bank and filled out a beneficiary designation form, and that beneficiary designation form says, these people get my money when I'm gone, and the form has POD, payable on death, written on it, all those things will automatically bypass probate. Understand, that's free. Or you can pay $2,000 to $6,000 for a trust that'll say that. So you can fill out the form for free, or you can pay $2,000 to $6,000 for a document that says these are going to bypass probate. Now, can't own your IRAs, so you name beneficiaries for those so they bypass probate. You POD all your bank and credit union accounts. What assets are left? Most people say my house. Okay? That issue is getting a little more involved since the state of Wisconsin pushed its budget through about 2.5 weeks ago. But your trust, if it's a revocable trust, can own your property, and your property will bypass probate, but there's no nursing home protection for that. You'd have to have an irrevocable trust. And after 5 years, because it's a 5-year look back, and we'll go into more detail about the Medicaid spend down process. 5-year look back. Understand, if you set up an irrevocable trust and you put your house in it, that's an asset that you no longer own. You've now given it away. Bless you. Give it away to an entity that you don't own or control. Not many people want to give up that asset. Now, you used to be able to put a life estate in place. Very simple document, $275 after 5 years, the nursing home can't touch it, automatically bypasses probate. Unfortunately, when the state pushed their budget through about 2 weeks ago, somebody managed to slip into that budget that they voted and passed a couple changes to life estates. One, they're no longer 100% protected, and two, they're going to try and make it retroactive. Or I should say, they decided to make it retroactive, which is illegal and unconstitutional. So there's going to be a ruling, there's going to be court cases, they're going to be fighting about this in the legal system, and hopefully come to a resolution after January 1st. So that simple fix of putting a life estate in place for $275 is going to be pretty much gone, but we won't know that until after January 1st. So what are your options? Your options are trying to figure out what you want to do with your house to protect it. Not only from probate, probate's easy. It's the nursing home. Do you have long-term care insurance or not? If you don't, do you understand how the process works? What they're going to take, what they're going to let you keep. And we're going to go through those details as well. Income tax, Social Security tax, inheritance tax, estate tax. There is no inheritance tax for the state of Wisconsin any longer. There used to be, but there isn't. There is just estate tax. And the estate tax limitation is $5 million per individual. So if you die and you have more than $5 million, any amount over $5 million is going to be taxed for federal and state estate tax. So once again, that's why I asked, anybody in here have more than $5 million? You might want to set up a trust, set up some life insurance to offset that taxation. If you don't, once again I question why you have a trust. Capital gains, issue that's going to be evolving as we go along, and Roth IRA conversions are still beneficial. Understand generally when things are beneficial for us, the government will do something to limit it or eliminate it at some point in the future. So take advantage of it when you can, and we're going to go into more detail about that. Now, do you do your own tax return or not? Make sure that you minimize your taxable income, maintain maximum deductions, and know what tax bracket you're in. All right? Certain level is 0. Certain level is now 10%. The next level is 15, then 25 as it stands today. How many people, to make sure I'm on the same page, think taxes are going down in the future? All right, so I don't want to make sure we're on the same. I want to be talking about some of you guys like, I don't agree with that. All right, so if taxes aren't going to go down, we have a $17 trillion deficit, and the number one revenue generating resource of our government is taxation of its citizens. They're going to have to tax us more to pay for that. All right? Know what tax bracket you're in. Know where the cutoffs are. You don't necessarily need to know that, but that's what I want to find out. And how do we take advantage of that? You know, we've gone from one extreme of, I've sat down with people who are in the 0% tax bracket, could be taking more money out of their IRA and not being taxed on it, but they weren't aware that they could do that. So they take the required minimum distribution and no more. Okay? And I've got people on the other extreme then. You know, they're in the 25% tax bracket and don't realize that if they just cut back on an income that they don't necessarily need to take, but another advisor was advising them, yeah, you need to have this income, which they didn't need, they could drop to the 15% tax bracket. So it's little things like that that we want to find out. The elimination of tax on your income, Social Security, inheritance, or estate all falls in line with all of this planning, is finding out where you are. What tax bracket are you in? And then we offer a tax smart second opinion to see if there are benefits for you to do a Roth contribution, if there's still W-2 income, or a conversion, meaning you would take an IRA and convert it to a Roth IRA. You get taxed one time in doing that, and that Roth will never be taxed again. So in essence, you'd be earning your tax dollars back the longer you go after the Roth conversion. Insurance solutions, life insurance upgrade, where are you right now? Medicaid spend down and how it works, the VA program outside of King, and then irrevocable funeral trusts and irrevocable estate planning trusts. Those are the last two places you can put money that the federal government will allow you to without having the nursing home take that money away. Now, where are you right now with your life insurance? Most people don't know because they bought it a long time ago, or maybe even your parents bought you a policy and it's sitting somewhere in a safety deposit box or a safe in the house somewhere or a drawer. Get it out. Find out where you are, okay, because it's important information. Don't just assume that when you die, somebody's going to get that money, because it might not happen. It might not happen. Now, let's assume you're a female age 70. You might have one or maybe even 5 policies, but the total cash value is $50,000. The total death benefit is $60,000. You've had some of these policies for a while, okay? She has 3 different options. One, she can just take the 50 grand out and say, you know what, I'm getting rid of my life insurance. I need that money for my retirement. Or, this is not much of a difference here. I'm going to take the 50 grand out and invest it and grow it that way so I control it. But understand, taking that out could be a taxable concern. If she still wants to do it, be smart about it. Take half out this year. After the first year, take another half out. At least you're taxed in 2 separate years. But think about what those options are if you actually need to take that or want to take that money out and don't want life insurance. Second option, she needs a loan. She only needs 10 grand. She realizes that this goes tax-free, so it's very important to her that kids get that money. She can take a $10,000 loan out of here. Okay? Now, if she passes away and doesn't pay the loan off, they'll knock 10 grand off the death benefit to pay back the loan. But understand, her kids still get the remaining money tax-free. Third option, and this is the option that none of the other insurance agents who sold her the other policies is ever going to talk to her about. She could take her $50,000, and if she doesn't have to or need to borrow against this or take it out, she could take her $50,000 and she could get rid of that 1 or other 5 policies through a 1035 tax-free exchange, in essence buy, with her $50,000, a new policy with a different life insurance company. And a standard rating for a female age 70, she could take 50 grand and buy $134,354,000 tax-free death benefit. Now, does everybody see the benefit of giving this to your kids tax-free as opposed to this? If you don't need your cash value? Because I've run probably, 50 of these over the last 10 years, and I've had maybe 5 or 6 people say they're not interested. One was because he knew his insurance agent since he was 8 years old and didn't want to take the policy away from him. Even though I explained that your wife gets this instead of this if you die. He still made a decision not to move the policy. His wife was okay with it. But understand, my job is to give you your choices. Your job is to tell me yes or no. I want this or I don't want that. That's how you're going to build your plan. That's how you're going to come up with these things. I'm going to come up with the idea. You tell me whether or not you don't like it. You don't like it, don't want to do it, fine. But at least you now know you could have done this as opposed to this. All right? Yes?
How is that possible for that much more?
Because when she started this $60,000 death benefit, there was no cash value in the policies. She paid her policies, and little by little, that cash value started to grow. And eventually, who knows how many years later now, she's sitting on $50,000 in cash and a $60,000 death benefit. Now understand, she dies, they pay this out. That's just a calculation at that point. Okay? So, you either do something with it, or you don't. Now, here's the problem you have. Medicaid spend down. All right? If you're single and you end up in a nursing home, you get to keep $2,000 in cash and roughly about $45 a month. They are increasing that. It might go to $75, but here's just the basics right now, okay, for conversation's sake. If you're married and your spouse goes to the nursing facility, you get to keep somewhere between $52,000 and $115,640. Understand, there are 2 levels. Most people just assume it's 52 grand. Well, it is if that's all you know. So understand, you go to the nursing facility, or your spouse does, and you don't have long-term care insurance, and you don't want them to take all their IRA money, and you don't want to take the $300,000 you got in the bank. You have to know how much they're going to take and what you can do with the excess money. That's my job, with the help of my attorney. But understand, the simple process is here is you have a client who's got 120 grand in the bank. You're going to go in and apply because your spouse is in the nursing home. They're going to deny you because you have $120,000. And they're going to tell you that you have to spend your 120 down to 115,640. And then your spouse will qualify for Medicaid. Not a big deal. Same client doesn't know what she's doing or he's doing. And they take the 120 and they pay the first month for their spouse. Now they drop down to $112,000 in the bank. Then they finally run into me and they say, I'd like to, figure out what you can do for me. And I say, well, let's apply for Medicaid. They say, well, we have $112,000 in the bank and we can't come up with any other money. So we apply for Medicaid and they turn you down. But now they tell you, you have $112,000 in the bank, spend it down to 52 grand and then your spouse will qualify for Medicaid. Because you didn't go in over 115,640. That's the biggest mistake I see people make, and there's a client making it right now. There's too many kids involved. One's the power of attorney, the other one's joint on some account. They're arguing about the assets and who gets what. And I'm in the middle trying to say, you need to apply right now, or mom doesn't get to keep the 115,640. And you need to stop paying the nursing home until we get this done. She didn't care. She got better things to do. She got work, she got family, she got more important things to do. So she kept paying the nursing home. They went from $187,000 down to 92 grand. And now she thinks it's important to come back to my office. Well, what am I going to tell her? Keep going, because now you got to go all the way down to 52 grand. Come with me with more than 115,640, or do what I told you originally to do. This would be your number. Now it's not. Okay, so understand how this works and how important it is to have somebody help you through the process of going through this. Understand, when this comes into play and your spouse ends up in a nursing home, they're going to ask you for a statement of assets. Please fill this out. It's basically a Medicaid application. You aren't going to fill it out. You can't deny your spouse care just because you haven't filled it out that day. You fold it up, put it in your pocket, call me, come to my office. You're going to give me the form. I'm going to take the profile I have because you're my client, and I'm going to go through what we're going to do with your assets. Do you want to make improvements to your home? Do you want to buy a new vehicle? Are there other things that we can do, irrevocable funeral trust-wise? Once we're done, I'm going to call my attorney. I'm going to revamp your profile showing exactly what we did, and I'm now going to pass it over to him, and he's going to apply on your behalf. When you get declined, because we're coming in over 115,640, he's then going to come back and basically reapply then at that point saying, hey, you guys said you had 120 grand in the bank, you need to spend $4,560. And I'll tell him, here's what we're going to do. He'll put it on the resubmission, and he'll put it back in. But understand, it's after we've gone through the Medicaid spend-down process. The attorneys only use what we need an attorney to use them for. Apply, and then send the rebuttal in for the rejection. But that in a nutshell. Now, of course, you get to keep monthly income somewhere between $25.61 and $32.78. Once again, all in how you apply. And this is the spouse that's not in the nursing home. Primary residence, provided you don't have more than $750,000 of equity in it, and it's your only asset. So, how many people own $1 million house and no furniture, no bank accounts, no money? It's the state's rule, and we just have to adhere by it. And one vehicle, so you can buy anything. $275,000 convertible Lamborghini. I don't know how beneficial it is in the Wisconsin winter to drive around in, but you can own one. But that's how it works. And understand, too, the state of Wisconsin considers this an asset. If your spouse is in a nursing home, this cash value is now an attachable asset for spend down. So, your spouse has $200,000 in an IRA. They want it. If you don't take it out and do something else with it, you'll blow through the $200,000. If they're still in the nursing home and they have a life insurance policy, they're going to want this $50,000. And they can now force you to take it out. If you're forced to take this out to pay for your spouse's care, that policy will lapse and expire. Done, gone, you lose the life insurance now.
But if you do an exchange, will you have 50,000 in the new policy?
No, and that's why I recommend if you don't have long-term care insurance and you want this to go to your kids tax-free, take your $50,000 and buy this policy. Okay? Now what you're doing is you're buying a more expensive policy, so the internal cost is a lot higher. So the $50,000 in this policy or policies right here will continue to grow, because you, bless you, because you had them for a while. Dumping that $50,000 in here, that $50,000, if interest rates don't go back up to 8–9%, which I doubt they're going to in the next 5 years, that $50,000 in this new policy will be gone 8 to 10 years from now. It'll burn off. The internal cost will just eat it away. Now understand, this is good until she turns 121. So it should last her the rest of her life, whether there's cash value in it or not. But understand, she ends up in a nursing home, or he does, your spouse does, and you've done this already, you have a very small issue to deal with. Let's say that you went in a nursing home and didn't do anything, your spouse ended up in a nursing home. You could take 50 grand and buy the life insurance from your spouse, but who wants to pay $50,000 for a $60,000 death benefit? And then once you give the $50,000 to your spouse, you have to figure out how you're going to spend it. Irrevocable funeral trust, or you're just going to give the 50 grand to the nursing home. Dump the 50 grand in here, it could be gone 8 to 10 years from now. Let's say it's not, but there's only 10 grand in there. Wouldn't you rather pay 10 grand to your spouse for 134 grand in return, tax-free? The 10 grand then when you give them is a lot easier to reposition. Buy an irrevocable funeral trust and stick it in there. It's kind of a cat and mouse game that you're playing here with these assets, but they have to be in these certain positions where the state of Wisconsin will require you to hand them over.
Does the Roth IRA also have to be?
Individual account, that's why they always want, if your spouse ends up in a nursing home, they want their qualified money first. Because they know qualified money can never be jointly owned. Never. Roth IRA, IRA, traditional, inherited IRA, 401k, 403b, 457, those are all individual retirement accounts. IRA, individual retirement account. They'll never be jointly owned. So if your spouse ends up there, or you do, they're going to want your spouse's IRA money first, or qualified money first. Because they know there's no attachment. There's no, let's add it up and see if it comes up to 115,000 or 52, like your joint money. Your individual money is fully exposed. Now, if your spouse goes, you get to keep your IRA money. My spouse ends up in a nursing home, I get to keep my IRA, my Roth, my 401k. But I have to turn over theirs. Then I got to go through our joint money and find out if we're over 115 or if we're over 52. Got to make sure we don't own more than one house or more than one vehicle. So understanding that it brings all this stuff into play. If you truly want and see a benefit, I mean, I see the benefit of just passing on more tax-free money, let alone the fact you're going to try and burn off your 50 grand so it's not an attachable asset. I mean, the primary thing for me is, look at the difference in money. I mean, that should first and foremost make sense. The other thing then is, are you or your spouse a member of the military service? Now, you can always go to King, you can get long-term care there, but there's a VA benefit aside from all that other stuff. A program that has $39 billion in it, where you can qualify. So we run both the equations if you're a vet. Was this more beneficial, or is Medicaid spend down more beneficial? And we run through both those scenarios. The issue that you have is applying for the VA benefits. Very few people know how to do it. My brother served in the military, so I called him when I found out about this, and I said, are you aware of the VA benefit? And he goes, no. I'll ask the head of his, I don't want to call it a bar, but that's pretty much what it is, that he hangs out at. Anyway, for vets. I don't want to say a lodge either, that's not correct. Anyway, the place where he hangs out with all the other vets. The Legion. Yes, the Legion, there you go. He said he would ask his representative down at the Legion. You know who the representative is? The bartender. He has no idea. I asked him to go in and ask him, can you find the VA benefit form, claim form, whatever it was that I think it's 8853, something like that. No idea. And he's the guy who's supposed to help all these guys apply for these benefits. So nobody even knows that the money's sitting there. Luckily, the government severed it from all other connections. They can't go in and pilfer it. They can't borrow from it. It's an isolated benefit program. So we run both of those scenarios to see which one's more beneficial for you if you are a vet. And there are criteria that you had to serve during certain wartime events, and they're very specific. So, got to go through all that. Irrevocable funeral trust, irrevocable estate planning trust, they're both protected from Medicaid, with one exception that the estate planning trust, it's after the 5-year look back. Used to be a 3-year look back on assets, now it's a 5. The funeral trust, though, is protected the day it goes in. I had a client come into my office and say, my mom's in a nursing home, but probably nothing you can do for her. I said, does she have more than $2,000? Well, yeah, she's got about 24 grand. I said, perfect. I said, she's spending it? Well, yeah, about 6 grand a month. I said, stop paying the nursing home. That's what I mean, stop paying the nursing home. I said, stop paying the nursing home. Your mom gets to keep 2 of the 24. Got any brothers and sisters? Nope. Okay, are you married? Yep. I said, great. Keep 2 grand in your mom's account. Bring a check in, 2 checks actually. Each for $11,000, one for you and one for your spouse, and we'll put it in an irrevocable funeral trust for each of you. So now your mom is passing on to each of you coverage for your funerals. She applied, and we put that in place, then applied for Medicaid, and she got approved immediately on the first application because she fit the criteria. She only had 2 grand in her bank account. The 2 gifts that she made were legal gifts to an irrevocable funeral trust, because you can set one up for any natural, adult, or adoptive child that you have, or your spouse, and any other spouses. So I had a client whose dad had been in a nursing home for about 9 years, had dementia, pouring out about $7,200 a month, and he had over $1 million. I mean, he was in there for a long time. And he came to my office. He's got 4 brothers and sisters. They're all married. His dad already had an irrevocable funeral trust, and he had about 170 grand left in the bank. I said, you realize that we could take $150,000 out of his account, set up your irrevocable funeral trust for you and all your brothers and sisters, and all your spouses. $150,000 we could spend right now. He said, sounds like a really good idea, but I got to go talk to my attorney, and I'll call you back. Never came back to my office. So I called him up, and his attorney said, that doesn't sound right. You can't do that. And that's what he told me. My attorney told me I couldn't do that. I'm not an attorney, but I've done that, I don't know, 75 times. So please don't tell me you can't do something I've already done. All right, generally when I tell you this is what I recommend you do, I've already done it and done it a number of times. Or I've talked to a CPA who says we can do it. Or I talked to an elder law attorney who told me this is the new rule and this is what we can do. Okay? So generally if I tell you you can do something, I've already done it. I don't care who else doesn't agree with that. Income and finance planning. This is where we're going to talk about the big A word, annuities. I don't see anybody shaking. I don't see anybody fainting. Nobody in disgust that I used the A word as loudly as I did. But of course, Clark Howard isn't here, so I don't think I'll get a huge number of objections. The only reason I mention that is because Clark Howard doesn't like annuities. Anybody ever go to see him? No? Okay, then I guess it's a non-issue. Clark has no idea what he's doing. Come to my office, I got one of his books in there because he just happened to see my wife the day after he came to Appleton. I went to see him the first 3 times. Promised my mother-in-law I wouldn't embarrass her because I put up microphones so you can ask questions. I promised I wouldn't ask any questions and embarrass her. Last time he came, I said, I'm going and I'm asking questions. She said, I'm not going. So she stayed at home. And I got there and I asked him the questions. I said, this is the same questions that if you're talking to somebody and they say, oh my God, I don't like annuities, or you should put money into an annuity, or don't do this, or you're going to lose all that. 2 questions, just to make sure you're getting information from a credible source. 1, what type of an annuity don't you like? And 2, how many types are there? That's the clarification question. So if that person says anything other than 5, they're wrong. They have no idea what they're talking about, and they're now passing on to you the misinformation they got from somebody else that they don't completely understand. Clark Howard hemmed and hawed when I asked him those questions. First he made a wisecrack about me using the A word in front of the aged crowd that he was in front of talking to. Tried to dodge it, and I asked it again. And he said, well, there's immediate fixed, couple other ones. I'm like, really? That's your answer to my very specific question? Just need to know the number. How many types are there? And he couldn't give me it. Now my wife, who works for a credit union, was down in Milwaukee at a credit union convention, and the guest speaker was Clark Howard the next day. He got done, opened up the room for questions, and my wife said, I don't want to make you mad or anything, but my husband went to see you yesterday and was not happy about your answer to his annuity question. And Clark Howard was vehement about apologizing, saying it was just his personal opinion, didn't really mean a whole lot. And that got me even further frustrated because people are in that room when he's talking, writing stuff down. They're going to go home and word for word run their life by his suggestions. Oh my gosh, Clark Howard says I need a reverse mortgage. I'm going to go get one. Let me write it down and go get it. Clark Howard says I need an immediate annuity. I better go get one. Okay. Here it is. There are 5 types of annuities. There's immediate, there's fixed, there's variable, been around for decades. 1995, they developed a fixed index and an equity indexed or regular indexed annuity. These were developed in 1995 and sold ever since. Those are the 5 types. There are no other kinds. There's not a 6th or 7th or 8th one. If you have to categorize annuities, these are the 5 types. Now, everything above the red line is an insurance product. Everything below, and there's only one, is a securities product. You have to be a broker or be in the brokerage industry or have a broker's license. Stocks, bonds, mutual funds, and variable annuities. That's what you sell. Everything else, it's an insurance license. Those are insurance products. These products right here are like CDs. So somebody comes to my office and says, I lost a bunch of money in my I lost a bunch of money in my annuity. I ask them, how long have you had your variable annuity? And they say, well, how do you know if it's variable? I said, because this is the only one that can lose money. Saying that you lost money in one of these is like, okay, how many people bought a CD the last 5 years? Last 10 years? You ever lose any money on it? Is it possible to lose money? If you take it out early, right? Same thing. The only way you're going to lose money on any of these is if you take them out early and you break the contract you signed. Whether that contract was 1 year, 5 years, 10 years, 14 years, 15 years, 16 years, 17 years. You can go out 17 years with some of these products. You pull them out early or too much, they will penalize you, but that's the only way to lose money. So if you come to my office and say, I got an annuity and I'm losing money, I'm going to ask you how long you had your variable annuity. That's the only one that can actually be exposed to losses in the market. Now, immediate annuity. This is one Clark Howard says everybody should have. You give a company, an insurance company, some money, and you tell them I want it back over a certain number of years. So I'm going to give you, my insurance company, $100,000. I'm going to tell them I want it back over a 10-year period. They're going to pay me $10,000 a year plus interest. If I die within the 10 years, my beneficiary gets the remaining payments. But at the end of 10 years, it's done. They've given me $100,000 back and all the interest they promised to pay me. Now you can take it a step further, because this is, in essence, what this is a pension. The only difference is you're funding it, not your employer. Give them the same $100,000, say I want it back over the same 10-year period, but I want to attach a lifetime option. 2 things change. You're not going to get $10,000 a year plus interest. You're going to get $8,500 roughly, based on your age. Die within the 10 years, your beneficiary gets the remaining payments, but it's $8,500 a year. But understand, once you get past the 10-year period, they will keep paying you $8,500 a year for as long as you live. When you die, it's done. So you settled for a lesser payment to get a longer one. Like your pension. You want the highest possible payout from your pension, what happens if you die? Your spouse gets nothing. If you settle for less and you pass away, your spouse will get 50% of that payment. Less, they'll pay 75, less, they'll pay 100. Same thing. Now, Clark Howard seems to think that this is the only annuity that you really need. Understand what you're doing when you do this. You're locking in interest rates where they are right now. How many people think interest rates are good right now? How many of you like to lock them in for the rest of your life? That sounds like a really good thing to do, doesn't it? I just met somebody not too long ago, gave $395,000 to an insurance company because he wanted basically $1,200 a month for the rest of his life. I said, That's quite an investment, quite an investment. And we looked at the terms of it, and there's no way to get out of it, because once you start it, it gets fully annuitized, and you can't break that contract. Even if you want your money back, you're willing to pay the fees or whatever it is, there are none. You cannot get your money back. So he's stuck with it. And he said, stuck with it, I'm getting my $1,200 a month, that's what I wanted. I said, one, you're not getting the most money that you could have got. Take that $395 to another company on the independent market, which I represent, and he could have got about $13.25 a month. So he went to somebody at the bank or credit union who was going to give him a great deal, got a lower payout, and then I asked him, I said, what's your interest rate that they're paying you? He goes, what do you mean, interest rate? I'm getting $1,200 a month. I said, you gave them $395,000. They have to give you an interest rate. That's how they calculate out your $1,200 a month. Well, I didn't know that. So we called him up. He's making 1.67% on his $395,000 for the rest of his life. Because that's what he got locked in at. So, when I tell you Clark Howard doesn't know anything about annuities, that's pretty much my basis there. Plus, my wife went to see him the next day. He was a guest speaker. I asked him about that. Well, anyway, Christmas wasn't so long after that. And guess what I got for Christmas from my wife? Clark Howard's book, correct. If you open it up, on the inside, it says, Clark Howard, I love annuities. And he signed it. Yeah. So understand, those people that are writing down every word that he says, yeah, it's his personal opinion. All right, take it for what it is, but he doesn't know squat about annuities. Fixed annuity, just like a CD. All right, no fees or upfront charges are guaranteed. There's no market risk. You get a fixed rate from 1 to 10 years, your choice. Now, unlike a CD, they grow tax deferred because they're annuities. They're probate free because they're insurance contracts with named beneficiaries. So if you die, they automatically bypass probate, pay out your beneficiaries. And once you go past a year, you can get access apportioned, usually 10% of it, penalty free. There aren't any CDs out there where you can go in. You sign a 3-year CD, you can go in the second year and take out 10% without being penalized. You sign a 3-year CD, you're in for 3 years. There is no penalty-free access. You go into a CD and you don't touch it. What do you get at the end of the year? You get a 1099 for the interest. Now they're taxing you on money you can't touch. And if you do go in early, what happens? They penalize you on the interest rate. Now none of that's very bad. Why? Anybody check out CD rates lately? 0.5%. If you're lucky, got to have more than 10 grand, and you got to go 15 months. 0.5%. So guess what your penalty is if you go in early? 0.25%. So it isn't a whole bad. So if you have CDs, don't worry about it because we can fix that. The 1-year fixed annuity rate is 1.65%. 12 months, that's it. 12 months from now, it's done. You have to decide what you want to do, just like a CD, except it's a 1-year annuity. The 3-year annuity rate is 2.4%. The 5-year annuity rate is 3.5% a year. So if you want a CD, you really don't want a CD. You want a 1-year, 3-year, or 5-year annuity. Now what's the catch? There's a catch to everything. You have to be 59 and a half or older. Annuities adhere to the retirement guidelines of not accessing them before 59 and a half. That's how they get to grow tax deferred. It's a retirement vehicle. So if you're 57, you come to my office and say, I want that 1-year 1.65% interest rate. I'm going to tell you that's fine, but understand, next year you're going to be 58 and we're going to have to renew it for at least another 2.5 years. Or at least another, 1.5 to 2 years. Because until you get to be 59 and a half, you cannot take that money out. For a seminar I did about 3 years ago with this, I got tons of phone calls. I want that 1-year rate. I want the 3-year rate. I had people showing up at my office left and right. I'm like, this is great. Then they kept walking in and I'm like, how old are you? I'm 42. Guess I should have clarified. 59 and a half or older before you start telling everybody about the great interest rates. All right? Fixed to fixed index. Fixed to fixed index. You're now going to a longer term contract. You're now getting more options, more bells, more whistles. They're going to throw more things at you. They're going to try and get you to add more things to your contract. Understand, when you add things to your contract, there are fees associated with those. If you don't add things to your contract, there are no fees. Very simple. Now, you have the fixed rate. We all know what that is, but they reestablish it every 12 months on your anniversary. So if you started your contract today, 12 months from today, on this day, you're going to have your anniversary. They're going to tell you what the new 12-month rate is, but they're also going to give you these indexed options. That's your opportunity to say, okay, over the next 12 months, I want this portion of my money, or I want all of my money in this annuity in the S&P 500. Now understand, they'll put it in a year later on your anniversary. They'll look back and see what that index did. What did the S&P do over that 12 months? Did it go up, sideways, or down? If it went up, we're going to give you a portion of the gain. If it went sideways or down, you get a zero. How many people would like to have gotten a zero in 2008? Oops, we put you in at the wrong time. Sorry about that, my advice wasn't that good. I'm just going to give you a zero, okay? We're not going to take any money out of your account. We're not going to add any to it. I'm just going to give you a zero. I know, guess what? The market went from here to here. I'm going to give you a zero, and then we're going to start from here. And we're going to try it again. So if it does go up, I'm going to give you a portion of that gain. If it keeps going down, I'm just going to give you another zero, and we're going to start down there. That's how the indexed option works. Regular indexed. Exactly the same as a fixed index annuity, except you have no fixed rate. So you either get a zero or you go up. At no point in time could you ever move your money to a fixed rate. Now imagine this is your IRA that you put this in. You're 70 and a half. You have to take a required minimum distribution. A certain percentage every year. Starts about 3% and incrementally increases over your lifetime. Your anniversary is today. By the end of the year, you have to take out your required minimum distribution. Okay? So, we have your anniversary today, and I decide, you know what? We should be in the S&P and not the Dow. But understand, in here, you don't have a fixed option. So we reallocate your money. Now understand, for an entire year, you're not going to get credited on your required minimum distribution because it hasn't grown. It won't get credited till the following year, but you have to take it out before the end of the year. If you had a fixed account, what we would do is we would take your RMD and we would dump it in there. We'd put the rest in the index, and at least your RMD, before you take it out, would earn some money. But I see far too many people who have one of these, because they heard it goes up and doesn't go down. And it's their IRA, and now their RMDs aren't growing at all, because they have to pull them out before the crediting's done. So be very, very careful. This is just a limited version of a fixed index annuity. Why would you want a limited version of anything? I don't know. Now we're leaving the insurance industry, and we're going to the brokerage industry. Variable annuities have high fees and charges. They're guaranteed, but only through the death benefit and payout options only. And your money's still at risk for market loss. Now, go back to, this will be in May of last year. Not this last May, but the May before that. Because Mays are notoriously bad year over year, with the exception of this last one. It was June instead of May. But last, 2012, take $100,000 May 1st of 2012, put it in a variable annuity, and on June 1st, you would have been down 10%. So understand, you gave them $100,000 of your money. 30 days later, you have $90,000 in cash, but you have a $100,000 death benefit. They're going to take with the initial premium that you gave them, and they're going to lock it in as your death benefit. So if you die, they'll pay $100,000 to somebody else. Understand, this is your retirement money. $100,000 to somebody else. But if you wanted to go in and take 10% out 30 days later, you're taking out $9,000, not 10. Okay? And understand, this is not a death benefit. How many people think dying during retirement is beneficial? Dying during retirement is beneficial? Anybody in the room? All right? This is a beneficiary benefit. There are no benefits to dying during retirement. All right? Especially if you haven't done proper planning. The payout option is even worse. And this payout option is something that you can add to any of the annuities that are out there. They're going to take the $100,000 And on a chalkboard somewhere in the corporate office, they're going to take your $100,000 and they're going to add 6% to it every year. And they're going to put that number on your statement that you get every year. But it's a number. It's not actual cash. Your cash value will be listed on your statement. So will this guaranteed minimum income benefit or guaranteed minimum withdrawal benefit. Okay? It's a number. So, let's say you stuck $100,000 in here. And actually, let's go through the other. Let's do it here this way. Cash value, income value. Cash value on a fixed index annuity, the bonus is less. Bonuses are higher on the income value. Gains are based on market fluctuations. Increase is fixed. Withdrawals are limited to 10%. Withdrawals are limited percent based on age per year. This is a fixed index annuity that we added this guaranteed minimum income benefit to. Understand that this is what happens to your cash within the policy. They may have to give you, taken your $100,000 and give you a 5% bonus. And then your gains will go up with the market, 0 if they go down, and you're limited to taking 10% out a year. Not bad for your cash. On this side, they're going to take your $100,000, they're going to bonus it 10%, then they're going to increase it by 6% every single year. Understand, this is a number. Now, you want to take money out sometime in the future. Withdrawals are limited to percentage per year based on age. So, 10 years from now, you have your cash value, which is $150, but your income value is $175. Which one are you going to want? Because everybody keeps talking, my $175 is guaranteed. Okay, my question is always, how do you get it? Well, they're going to base it on your age. So if you're 70, they're going to give you 4% of that $175 a year for the rest of your life. Now, if I give you 4% of anything, how long is it going to take you to get 100%? 25 years. So to get the 175, it's going to take you 25 years. Or you can take your 150 in cash. Now, it's even worse when you do it. I'm going to skip past this. We're going to do the variable annuity one right here. Bonus is the same as the income value. So they'll bonus your cash and your income value the same amount. So your cash value goes up 5%, your income value gets a 5% bonus. Gains or losses on the market. Understand, you got a 5% bonus on your $100,000 up to $105,000. We have another May like we did in 2012. You're now down to $90,000 in cash. Over here, 100 to 105, and now it's grown by 6% again. That number. Withdrawals, once again, limited to 10% when you add an income value. Same thing, based on age. What you have to understand with this income value is it is a number that's being calculated to figure out how much of your actual money they're going to give back to you. 4%, maybe 5%. Understand, that's a 25-year payment or a 20-year payment. Let me feel like it would be a good idea right now. You're going to give me $100,000. You can't touch it for 10 years. I can do whatever I want with it for 10 years. 10 years from now, I'm going to guarantee to give 4% of that money back to you for the rest of your life. Oh, and in the process of that, on a variable annuity, the fees are anywhere from 3 to 6% per year. So every year I can take 3 to 6% of your money out. You can't touch it. And then 10 years from now, I'm going to give you 4%, $4,000 every year for the rest of your life. How many people think that's a good investment? Well, it is if the market goes straight up. Never goes down again. How many people think the market's going straight up and never down again? Otherwise, put it in basic terms with some of these annuities, you'll find out that they aren't everything that people think they are cracked up to be. That's why I don't ever, unless it's something that you tell me you really need to have, I want $1,200 a month starting at this age or this date. I will go to the independent market to find out who will cost you the least amount of money to secure that. And I'll get it for you. But if you don't tell me you want this, I'm certainly not going to add something to your policy that's going to charge you anywhere from 0.5% all the way up to 1.5%. Okay? Now there are income values like this that will double or even triple if you end up in a nursing home. There are income values like this that you can add to an IRA. So you can get a joint lifetime payout from your IRA. Even though your IRA can never be jointly owned, you can attach a joint lifetime payment to it. So there are some beneficial ones, provided your situation is appropriate for that. And it's something you actually want. If it's not something you want, why would you add it to your contract? I'm going to skip past this because that's going through the same 6% calculation. Susie Orman has written, I think, 14 of these books, tapes and stuff. This is the one I have in my office. I like it because it's a pretty easy read. They ask her a question, they type the question in, then she gives her answer, and they type in the answer. The annuity section starts on page 470. They ask her on page 473, how do I know if an index annuity is right for me? Her answer is, if you don't want to take risk but still want to play the stock market, a good indexed annuity might be right for you. On page 470, her first question was, my financial advisor is recommending I buy a variable annuity within my retirement account. What should I do? Her answer was, get yourself another financial advisor pronto. Now, she prefaces this on page 464. She goes into a whole section about variable annuities, but this is the snippet that I got that kind of explains, for many reasons, including high fees and benefits that, in my opinion, are routinely overstated by salespeople, variable annuities are an investment I often warn against. You say there's a guarantee on the downside. What if the S&P goes down 30%? In fact, for those who do not want to take any downside risk, the indexed annuity can be a good option. Unlike regular indexed funds, where you can claim 100% of the decreases, in an indexed annuity, my money can only go up, it cannot go down. Let's say the market does this. All right? Take a look at the fixed annuity. You don't want to bother with the index. You don't want to bother with anything else. You just want a fixed rate. Well, fine, let's get you one. Let's say it's 3% on $100,000. Now, understand, if you want an annuity, there are companies offering bonuses. Billions of dollars are going into these products every single year. It's a competitive market. This company will give you a bonus if you go to them instead of going to the other company. It's free money. You should take advantage of these things. We're not going to talk about bonuses or riders. You negotiate a 3% rate, that's exactly what you're going to get. Regardless of what happens to the market, you negotiated it just like a CD. I want the 3% rate, that's what you get. Now we've got fixed, indexed, or equity index because the index works the same. Understand, fixed index you have a fixed rate, equity index you don't. We're just talking about the equity portion of both those contracts. Market goes up, portion of the gains, not all of it. Market goes up, portion of the gains, not all of it. Does this look familiar to anybody? 98, 99? Does this look familiar to anybody? 2006, 2007? I'm pointing to the same line. This line right here. This is our third time down this path. Third time that we've reached an all-time historical high in the market. First time, 2000. Then the big crash, 2000, 2001. Second time, 2007. New all-time historical high. Followed by a new all-time historical low that we hit in 2009. Now we are once again at new all-time historical high. Anybody think we're going to do anything else than what we did the first two times? Because if you do, I'd like to know what crystal ball you're rubbing. I'd like to see what kind of information that thing's spitting out, because I don't think, when history tends to repeat itself financially, that anything else but that happens. But understand, this is the path. Now understand, 2000, 2007, where we are today. Market goes down, you get a zero. Market goes up, you get a portion of the gain. So understand, over the long haul, unless you can tell me that the market's not going to crash ever again in your lifetime, you are going to end up farther ahead with a fixed indexed annuity than you will buying mutual funds. Now, let's take a look at the variable annuity, because this is the market in and of itself right here. Awesome. Made $15,000. How many people have got that one guy like I do? Calls me every time the market goes up 20%, tells me about all the money he's made. Always ask him, are you back to even? Well, no, who is? Not back to even, but who is? Then you don't hear from him for about 3 or 4 months. Why? He didn't make any money. As a matter of fact, he lost the 20% he just told me he made. Oh yeah, that's the guy you're going to hear from right here, because you only made 7%, he made 15%. Then he's really going to rub it in the next year. When he's up 20, and you only got another 7. He's up 35%, you're only up 14. What he fails to realize is you don't have to give this back, ever. Now, he loses half of that 30%, or actually he loses the whole thing, and then some. You get a 0. Now, I'm not telling you that this is the point at which you go rub it into him, because he's lost a lot of money. A lot of money. He's not wrong to talk about that. He's not probably going to talk to you for a couple of years until the losses are over. Then the market comes back and he gets a little bit of his money back. Understand, in a variable annuity, this right now becomes your death benefit, $135,000. If you wanted to go in and take out 10% of your money, they're going to send you $6,750. If you die, they'll pay this to somebody else. Market comes back, they credit your account 10%. Until your account gets back up to the 135 and higher, the 135 becomes your death benefit. I've had far too many people over the years come into my office with variable annuities, money for their retirement that they're now sitting on because, well, it's more of a life insurance now. Because understand, if I try to take my money out and walk away, this is what I get. But if I die, that goes on to somebody else. So it's kind of my life insurance now. You want life insurance? Go buy it. You want to invest in mutual funds? Go buy it. The fees on a variable annuity are probably 5 to 10 times higher than the fees on a straight mutual fund purchase. These are the crediting methods, the limitations in fees, all the stuff I go through when I'm suggesting my recommendation to you. But understand, this is my job. Which one of these is the best in cooperation with which one of these? Which one of these is better for you? And understand, do you want a spread? Do you want a participation rate? Do you want a cap? That's my job. That's the research that I do. And if you knew all this, you wouldn't need me. Get an insurance license, start making some money. Talk to all your friends, tell them you know how to do this. This is why I have a job. This right here. Now, you need to do also this other stuff too. Oops. Oop. You need to know what your liquidity options are. How do you get your money out? Okay, that's the biggest thing. Ask the basic questions. You know, somebody sits down with me with a statement from their variable annuity company, and they're going, yeah, well, I might have, I started with 100,000 and I got like 90 in cash, but, I got 167,000 guaranteed. Basic question, how do you get it? Oh, I don't know, it's guaranteed. Every time I go in there, my broker tells me that's guaranteed. Why would I want to move my money? Because this is guaranteed. How do you get it? Basic questions. How do I get that money? Well, 4% a year when I turn 70. Okay, you're 65. You gotta wait another 5 years and not touch your money, and they're going to give you 4% of your money back. Does this make sense to you? The normal circumstances, when you get past all the sales hype and the sales jargon, I've been doing this for 10 years going on 11. I have. The reason I mention that is because I had a client who sent me an email from their, I don't think it's illegal for me to tell you, Thrivent representative, about how they shouldn't move their money. Because Thrivent has over 50 years of experience. Okay, let's break that down. Is that one guy that's got 48 years of experience and one guy that's got 2? Is that 5 guys that each got 10 years of experience? Because this is an email coming from 2 guys talking about how Thrivent has 50 years of experience doing this type of investment that they're recommending. All right, do they each have 25? You want to go down that road, keep asking the basic questions. I've been doing this for 10 years. Prior to this, I spent 1.5 years in the insurance industry. That's how I know all these sales gimmicks that they keep coming out with. All right? But this is the stuff that you need to know. This is my job. My job is to take these contracts and manipulate them for you, as opposed to you being manipulated by the sales tactics that they're used to sell these things. And then you find out you got something that you don't even want or need. Here's where you are with all your money. IRA, 401k, money at the bank. Where are you going to go? Everybody thinks it's this huge dilemma. Well, there's a bazillion choices. And how do I handle it? No, there's not. These are pretty much the places you can put it. There aren't a bazillion places to go. You can go to the brokerage industry, stocks, mutual funds, equities, bonds, and variable annuities. Win some, lose some, break even. Those are your choices. All the potential in the world. No protection. You can go to your bank or credit union Get all the protection in the world. FTCI insured up to 250 grand in account. 0.5% on a 15-month CD, 10 grand minimum. Here's your opportunity. You just need to figure out how to structure it. That's it. This is a little scenario I just talked about. This is when the market started, eons ago. We had a Great Depression, then we had our rebuilding years, and we got to 2000. Then this happened. They blended on the dot-coms and everything else. Then we dug ourselves out of this hole, and you got to here. And then this happened. And they blamed it on the mortgage-backed securities industry and reverse mortgages and Fannie Mae and Freddie Mac and blah, blah, blah. Now we are here. Actually, we're actually right up here now. We're a little higher than that right now, today. What's your plan from this point forward? You're saying, I didn't know that was going to happen, or I can't believe this happened again, a third time. What are you going to do? And those are all the things that I take a look at when I build your plan. Now understand, what's going to separate me from everybody else in town is the fact that I don't get paid for all this. I still do it. Why? Because if you have a problem with your retirement, an issue, a concern, you're calling me. If I don't have an immediate answer, I have people at disposal to get you the answers. I have a plan in place. There's some of these other guys that are selling this stuff, you ask them a question, I don't even know how they go about figuring it out. If they don't have a basic profile of your situation to look at, what do? Well, let me get your file out, figure out what we did, because I don't remember, because I never wrote it down, I just sold you something. Now, it's unfortunate that a lot of people that come to my office are bringing me stuff that they bought. I'd love it if we would have met when you were 50. Took a few years to plan out what you wanted to do, figure out the most appropriate thing to do at that point, and make sure that we're all heading in the same direction. Never met that individual yet. Everybody comes to my office and goes, here's what I got. And I'm fine with that. I sort through it, or I organize it, and I figure out, okay, well, you're going a direction with this, you're going this direction with that, and this is the direction you want to go in. So how do we get that all put together? And that's what I do. Now, I offer a free second opinion to anybody who's interested. Whether you are or not, if you would get out this sheet of paper, so we can get a head count for tonight to make sure that my bill for dinner is accurate. Fill out the top portion. If you are interested in the appointment to come see me, my schedule for the next 3 weeks is at the bottom. Pick a day and time that works best for you. Lori's going to come around and collect these. If you want the appointment, she's going to, at the first, give you this. Put the day and time of your appointment on it. Inside are a fact finder. Just fill out the first page of the goal sheets. That's your personal info if you have kids, where you live. The rest of it, I use your statements to fill in and build your profile. There's a couple other things in here. There's a list, in case you're not sure what to bring. There's 2 index cards in here, too. One's for another $10 gas card to get to my office and back. I know it's like $4 a gallon. It might not, depending on where you live. But basically, everything you do in my office is free. I've been doing this for 10 years. I have 262 households that I represent now, and nobody's ever paid me a dime. It's not how I get paid. My commissions are independent of your money. Okay, so you never will pay me a dime. Now, you come to my office, first appointment, you're going to bring that stuff in. We're going to sit down and figure out where you are right now. Then we're going to talk about where you want to be. And at that second appointment, when you come back, I'm going to have a profile built of your situation. It's going to look somewhat like this. Above the first red line, your qualified account. What is it? Who owns it? Who's the custodian? What type of investment? If there's a policy date or crediting method associated with it. We're going to put all your information for your retirement scenario on one sheet of paper. There have been some instances where I've had to go to 2, but I try to get it on one sheet of paper, so when we talk about where you're headed, my recommendations go in this far right column. Very basic, very easy to understand. Understand why it's very basic. Because I want to understand it. I want to be able to explain it to you. Alright? Now, if you want, I think I can still find the leather binding machine from my ex-partner. And I can give you a 30-page scenario for this one page. And we're talking colored pie charts, we're talking about graphs, we're talking about line charts. I will put it in a leather binder, I will put it together for you, and I will hand it to you. You know what you're going to do? Nothing. You're going to look at it and go, wow, I guess I'll just trust this guy because he looks like he knows what he's doing. And it's leather bound. I mean, who wouldn't trust this guy, right? I'd rather have you understand what you have, what we're going to do with it, and why. Simple terms, easy definitions, easy things to understand. You call me with a question, I'm going to pull your profile up and go, what should we do next with this? Or I inherited money here, or I did this. I can pull your scenario up in one sheet of paper and look back and go, here's the best scenario for you. Why? Because I'm looking at your entire scenario right here. Now, you may have to get out some old life insurance policies, you might have to get out this, might have to get out, understand, you're going to get it out one time. Once you get it out and I have it on your profile, you will never have to get it out again. Nor will any of your spouses or relatives if you pass away, because I have all the information I need to see them through the transfer of your assets from each of you to the other one, spousally, or onto the next generation. I don't need the contracts. If you bring them in, or your beneficiaries bring them in to claim the life insurance, I'll shred the document. Check off on the claim form that it's lost or stolen. Because if you have an older contract and you send it, I've been down this road too many times. Person passes away, spouse brings in the old life insurance policy and the back page is missing because it's so old. Send it in, the company then sends back a form saying you need a replacement contract because this one is invalid because it's not complete, it's missing the last page. So now your beneficiary, or whether your spouse or your children, has to apply for a replacement contract which takes 60 to 90 days. Then when they get that, they can resubmit their claim form to claim your life insurance beneficiary dollars because the company didn't recognize the old contract. Shred it, check a box, and there's no issue. So these are the things we've learned over the years to assist in putting this together for you. Now this is what you'll get at the second appointment, along with my recommendations. At that point, everything's up to you. Lori will call you a week later if you haven't contacted us, find out where you're at. I should say she'll call you 2 weeks later to see where you're at. If we still haven't heard from you 2 weeks after that or a month later after you've come to my office the second time and received the information and my recommendations, I'm going to call you just to find out if it's even worthwhile